Most people start investing without even realizing that they've chosen an investment style. And here's the thing, your investment style could be costing you thousands. So in today's video, I'm going to be breaking down the 5 most popular investment styles, the pros and cons to each, and which style could be right for you. Let me know down in the comments. Let's hop into it. Style number 1 is passive investing. This is usually done through using low-cost exchange-traded funds or ETFs. You can also use mutual funds depending on what type of account this is. And these funds track the overall market. And so for an example, you could have some large-cap funds, mid-cap funds, small-cap funds, that meaning large-cap companies, mid-cap companies, and small-cap companies. A great way to set up one of these types of passive investment strategies is to get on your broker's platform, go to their exchange trade fund or ETF portfolio builder, and it will have you fill out a questionnaire that will basically go over your risk assessment, and it will tell you the splits you need between stocks and bonds. And so an average kind of portfolio might have a mix of like average median return portfolio would have a mix between 60% stocks, 40% bonds, or if you want to have a little bit less risk, you could have 50% stocks, 50% bonds. Stocks are generally more riskier than bonds. And so you just set this up with funds, you set it and forget it. The great thing about this type of portfolio, the pros of it is generally low cost. It's also a low time commitment. Once you set this up, you don't go back and forth with it. So it's not a big time commitment. Some of the cons, also for the long-term investor, this type of portfolio generally has very strong returns. The cons of this one is that when we have market pullbacks, that meaning the market is down, these types of portfolios can be down for a bit because they track the overall market. But this is a great way to get started. This is actually how I first got started investing. When I first started I was doing this strategy in my 401k, and I still do a portion of passive investing, but I also do some other type of investing, which I'll talk about later in this video. So passive investing is the first way to get started. It's one of the most popular, and likely you probably are doing passive investing in your 401k at your job as well, because generally they have some different funds that your job will recommend to you, and then that's what you have to do and kind of set it and forget it. So passive investing is good for busy professionals, beginners, and anyone who doesn't want to spend hours researching stocks. Strategy number 2 is active investing, and this is when you're trying to outperform the market by picking specific stocks, timing trades, and stock market analysis. Some pros to this type of investment strategy is that you get to actively outperform the market, and you get to shift your portfolio to adjust to market changes, such as if you see that one sector or one company is doing better. So an example of that could be right now, there's a lot of AI is doing really great, crypto companies, and so even companies like, that we keep hearing about, like NVIDIA, a chip company, or Palantir, you can, Robinhood, you can shift to one of those companies and ride what that company is doing. So when you are doing active investing, you're looking for companies that are really booming, and you're looking to time trades, get into those, get out of those. But some cons to this one is that depending on what brokerage you use, the fees can be really high. Most people who try to actively outperform the market don't. And it requires constant monitoring. And so, this isn't like a set it and forget it approach. This is you're constantly following the market. You're constantly looking at what's going on and trying to see how you can have one leg up on what's happening in markets. And this is best for people who love to do research, follow the markets daily, and enjoy challenges of trying to outperform the market. And so I have done some of this as well. I've done some trading. I've also I've picked different companies. Sometimes what I choose does good, sometimes it doesn't. So this is for somebody who wants to be really keyed in. It's not a set it and forget it strategy. So if you're really into following financial markets, this one could be the right one for you. Strategy number 3 is a core satellite portfolio, and this is a mix between active and passive investing, and I really feel like this is that sweet spot. So this is where you have your passive strategies where you're tracking the market, but then you also peel off a certain amount of money that you're like, hey, I want to do some active strategies as well. So maybe this is some companies that that you're passionate about or that you like, or that you believe that are going to be front runners. And so you take a certain section of it to do that. I've seen people, when they do these types of portfolios, maybe they'll have 80% in the core, like the passive strategy, and then they'll take 20% to go after, the companies that they think are going to perform better. And so it just all depends on what your comfort level with risk is, because of course, when you're doing the active investing and when you're choosing some of the companies, especially when you're investing in individual stocks, when the individual stocks can fluctuate and have massive pullbacks. Like I was looking at Coinbase, I believe it was last week, they were trading at 440 last week, and then all of a sudden they were down like $100. And so you can, if you have multiple shares and multiple shares go down $100 a share, you can really see that and feel that in your portfolio, and you don't know when it's going to come back up. So having but when you have the core satellite portfolio, having a good section of yours in mutual funds don't react and have as strong of a pullback when the market pulls back, or as drastic, I would say, of a pullback, just because it's diversified through several companies that are in the fund. And so so some pros to this is balance and stability along with growth opportunities. So you get the balance of the core and then the growth opportunities with the satellite that you have going on with the companies that you want to see grow. It can target trends without risking your whole portfolio. So, you're able to go after companies that you say, hey, these are growing, and you can target that trend, but you still have your whole portfolio in a solid, stable setup investment according to your risk tolerance questionnaire. Some cons to this is more complex to manage than a fully passive portfolio, and risk still exists for the satellite portion. Of course, I want to go ahead and say that risk exists in all types of investing, but this, of course, when you're going after specific stocks that you think are going to outperform, can be a lot riskier. So I just wanted to hone in on that, because I feel like a lot of times people talk about what are the upsides of making the money in the market, but they don't ever really talk about the downsides, or when you can put money at risk and you can lose it. And that definitely is a real thing when investing in the stock market or investing in any other type of asset class. People can take losses depending on how their investment portfolio is set up. So this type of portfolio is best for investors who like some excitement but still want a solid long-term foundation. And so if you want to be excited about seeing a few companies grow, but you want to know that hey, your long-term outlook is invested in things in the whole broad market, so you're going to capture what the market's going to do as a whole, this type of investment portfolio could be great for you. And so I've done a passive and active, which really I would call my portfolio a core satellite portfolio, because I have some stuff that I just sit down and I'm like, hey, I'm not worried about it. I'm just going to let that do what it does. I'm not even going to check it. But then I have other things, or I'm trading a little bit in the market, and I'm like, hey, I'm working to outperform the market a little bit. So, it gives me a little bit of excitement. Also, I'm into finance. I work in finance, of course, because doing Steadyworth. So I'm actively tracking the market each day. And so, I find that it works for me. I don't want to encourage anyone the best thing, you don't want to do invest in anything that's beyond your skill level, because that's when you go beyond your skill level, that's when mistakes happen, and that's when money is lost. Now, example number 4 is growth and value investing. So set up a portfolio that is focused on growth stocks and value stocks. And this is buying companies expected to grow faster than the market. So this is like, if you say you're working on buying like a company like Tesla that has really performed well over the course of, like, I'd say since from 2000, if you look at how it's performed from like maybe 2015 to 2025, over the course of the last 10 years, it's definitely performed very well. So that would be a growth type company, whereas a value company would be a company like Coca-Cola. And so buying companies those value companies are generally undervalued when you're looking at fundamentals, but a company like Coca-Cola pays a solid dividend. And so you get that dividend coming in, and you get that nice stable company. It's a stable company. They have stable products that the market is already adapted to. Coca-Cola isn't doing anything groundbreaking, but hey, every time you look at a stadium, whether it's a baseball game, football game, basketball game, they're either going to have Pepsi or Coke, and then they're going to have all of their products, not to mention hospitals, schools, university campuses, like it's in gas stations everywhere. So it's a solid product that's going to be all over the world. So, having some value products is having some, so this is a growth versus value. Other growth stocks could be other tech stocks like Facebook, what is it? Facebook, Palantir, Robinhood, Microsoft, Apple. So those would be growth stocks, whereas, then you have value stocks, which are your much more stable stocks that are generally paying dividends. Some aren't, but just kind of give you that value in your portfolio. Some pros to this type of portfolio is that you can tailor your risk tolerance, growth for higher risk reward, value for more stability. Some cons to this type of portfolio is that growth stocks can be very volatile. A company like Tesla is up and down. If you've ever watched what they do, I mean, it has performed well over the course of the last 10 years, but it can be extremely volatile. And also, value stocks can stay undervalued for a long time. This type of portfolio is great, having this mix of growth and value. I would say for risk takers and people who have long-term optimists that, that tech and those types of growth industries are going to continue to just grow and do well over the course of time, even with the ups and downs. And then also having that piece of value that has that it also gives you a piece of like being a patient investor who likes to bargain and get a solid, stable return. So that's the growth value mix. The last portfolio type is a dividend growth income investing. This one focuses on companies that mainly yield a dividend and grow that dividend over time. Some pros to this strategy is that dividends create a steady income stream and dividends can grow your long-term investment over time. Some cons to this strategy is that it may have slower capital appreciation than growth-focused stocks. This type of strategies is best for retirees, income-focused investors, and those who want cash flow alongside growth. And people who are retirees are generally already pulling money out of their portfolio on a regular basis to support their lifestyle, maybe to do their required minimum distribution. So when you have those dividend-producing stocks, ETFs, it's actually, you can choose not to reinvest your dividend back into that company and actually have that cash stacking up in your account. So then when you need to take a distribution from the account, you don't need to actually sell one of your stocks or one of your positions in the account to produce the cash that you need. So this is why this type of investment is good for people who are actively pulling money out of their portfolio, but it's also good for people who just like to receive a dividend as well. I mean, I've helped different clients who are not in retirement set up some dividend ETFs in their portfolio, and they're really great. I mean, I have a few different stocks that I'm invested in that actually produce a dividend, but I actually have it going reinvested back right into the company. So I believe that if you're not at a point, like if you're not at retirement and you're not needing to raise cash and pull cash out of your account, you always want to have your dividends getting reinvested in, just because it then helps it reinvest back into the company that you're already invested in, and it buys a fractional share. So it keeps upping your investment into that company. Once again, none of this video, of course, is financial advice. This is for education and entertainment purposes only. And if you have any specific questions, you should consult a financial advisor about your specific questions, because of course your unique needs are very unique and they are more unique and dynamic than can be answered just on a quick 10-20 minute YouTube video. And so that is what I have for you today, with the different types of investments, the different types of investment styles. Which one are you? Are you a passive? Are you an active? Are you a core satellite? Are you a growth versus value? Are you a dividend investor? Which one speaks to you? Can you please leave it down below in the comments? Also, if you have a question, maybe you're like, hey, I don't know what type of investor I want to be. Maybe I like to talk it out. Feel free to use the link below. We can book some time and we can talk through, just what type of investment strategy may be right for you. I can also link a risk tolerance questionnaire so that you can go through there and you can take a risk tolerance questionnaire and you can see, what would you like your splits to be between stocks, bonds? Maybe you want to get some crypto into your account, depending on if that's something that speaks to you. Also, if you've made it this far, I really appreciate you for watching the video through. I wanted to say that we've been looking at our algorithm, we've been looking at our YouTube analytics, and we've seen that over 80% of the people who watch our videos aren't subscribed. So if you've been watching our videos and you get some value from these videos, please feel free to give us a subscription, give us a like, ring that bell. This helps get our message out to the world. We're working to just equip the next generation of young professionals who are looking to live a life that they're excited about today while staying within their means and building a financial future that they're excited about as well. Thank you for sticking with us. Have a great day, and we will see you next week. Bye-bye.